Hey everybody, welcome to the morning market briefing. It's Friday, February 27th, 2026. Hope you're doing well out there. As a reminder, this month we're promoting Jacob's Ladder Group, a local organization here in Cobb County that provides all kinds of support and research for lots of kids that are really in great need. So please check them out. If you go to jacobsladdergroup.org, there is a donate button. We also have an event coming up on April 1st. Lunch will be served at 12:30, and you have a chance to come hear from the director of that organization at 1 o'clock. A great way to get involved, even if you're not sure how it impacts you. It certainly impacts many in the community, so we would love to have you join us. Again, the Jacobs Ladder Group can be supported by going to the jacobsladdergroup.org and check them out. Ben, how we doing?
Doing all right. Doing all
Hanging in
right.
there. We've got, let's jump in with some economic data. We do have PPI coming in presumably right now. We bent time and added a little bit of pre-market show just so we could get the data. How we looking?
It looks like we're coming in hot.
Coming in hot.
All because of, do you think tariffs played a big role?
Oh, it had to have been massive, but now they're gone, right?
Yeah. So producer price index for goods was a whopping negative 0.3%. month over month, and is now down to, it looks like I'm reading this off the chart because it's difficult to get it from the actual numbers, but it looks like we're down to about 1.5% on the final demand goods in terms of producer price index. So that's prices that producers of final products are paying for kind of intermediate products. Yep. So anything that's kind of imported, so if you're building furniture and assembling furniture here in the United States, everything that you import for that is going to be a cost. If you're building in a final assembly of a vehicle is here in the United States, that's going to be included in this. And so this was a huge concern that we were going to have massive inflation.
And just a massive number there at 1.5%.
It's unbelievable. And it's the crazy thing. It is down from about 3% in November. So that's coming down where things really were a little bit hot was on the final demand services. But again, this can be, a lot of this is imputed data because of if the companies are making more profit, it is assumed that the prices are higher, that they're charging and the producers are going to have to pay. So again, and this was the same thing that we saw in December, said most of the January rise in prices for final demand can be traced to margins for final demand trade services, which jumped to 2.5%. A lot of this was related to transportation and warehousing services that were advancing 1%. And I would argue that's probably a good thing, yes, considering that companies were literally going bankrupt because they were operating at less than cost. So maybe your freight costs are going up a little bit, but again, I don't think that that's necessarily a bad thing, and I don't think that we're seeing runaway inflation, and certainly it's not because of tariffs.
Yep.
And so I think that these are all, you're going to have people complain about it, and that the producer price index came in super hot, and maybe bonds will sell off, but I think that that's just a phenomenally bad misread. And I think that if I'm looking at what's actually happening is that goods prices are down, and maybe in the trucking industry you're able to survive.
Yeah. Which, again, we talked freight yesterday. It's a favorable report, especially as we're thinking more broadly about the economy. If we are worried about specifically trucking and transportation and warehousing costs going up a bit to the tune of profitability for those guys, that's not a bad economic read.
Well, I mean, and then you look at some of these things, and they break out foodstuffs.
Foodstuffs. We love the stuffs.
That was down 3.5% year over year. Mm. You have energy goods that was down, energy goods and foodstuffs, but energy goods down 2% on a month-over-month basis. So I think that when we're looking at what's actually driving the economy and what the prices that people are actually going to end up seeing, I think that a lot of that's deflationary. And trucking, maybe they're not going to lose so much money anymore.
Yeah, I think
at least in February they didn't.
Yeah. Would be curious. I mean, he's not in today, or he is in today, but not in the call right now. But pretty interesting movements now. He just texted me, but seeing the 10-year now under 4.
Yep.
Not something we're going to chase here.
Did someone put that in the Teams chat this morning?
Yeah.
No, it's 3.98%, and the 10 years under 4, and the mortgage rate's under 6. I don't think we have to chase it, but I also don't think it's a bad buy. Like, if you don't have long duration, I don't think that buying it now is terrible. I mean, I don't think
you'd like to have bought it a few months ago, but
right? But don't let the perfect being the enemy of the good.
Yeah.
Again, you probably don't want to put all of your money into it right now. You want to leave space to buy more. But on a portfolio management basis, here's the beautiful thing that I'm seeing in interest rates right now, and we're seeing it again today. This is something that we did not see in 2022, but I think is a key element when you're thinking about if you're in retirement, or even if you're not in retirement and just wondering about, should I have a fixed income allocation or not? Fixed income right now is the perfect hedge. What do I mean by that? It has a negative correlation with your equity exposure, and it probably has a negative correlation with your income, because whether inflation's coming down or you lose your job, that will bring down interest rates and improve your bond prices. So it's good from those two perspectives. It's good from a negative correlation perspective, because that was not the case in 2022. You were losing your job and your incomes were, because inflation was spiking and everything was terrible, and bonds were selling off at that time. That's not the case now. People might be losing their jobs. We'll talk about that in a minute. Inflation's come down, but you're making money on your bonds. The other piece of that is, another hedge could be shorting the market, because it has the same functional reality in terms of you make money when the market does badly. The problem with shorting the market is that is a negative expected return.
It's also un-American.
It's un-American, and you expect to lose money on that over time. With interest rates on the 10-year at 4%, at the 30-year 4.7%, you're going to make money not only on a nominal basis, but on an inflation-adjusted basis. And that's incredibly important, and I think that if you have a positive expected return and a negative correlation, this is something that is really, really, really beneficial to your portfolio, because if equities sell off like they are this morning, they're down about 70 basis points, your bond portfolio is going to be up. Mm-hmm. And I think that's a really good thing for a balanced portfolio.
I think people often misconstrue the value of fixed income into a portfolio to solely, I think they focus on, well, if stocks are down, these won't be. And my bonds won't be. And that is part of the story. But the point that you just laid out, Ben, that I think is so vital for people out there to understand is, oftentimes when stocks are down, not only is this not down, but it is up. And it is not just a buffer. It's not just a gutter guard that's there keeping the ball from going in the gutter. It's also redirecting it back towards the pins.
Yep. The long bond's up 35 basis points this morning.
So. Netflix walking away from the Warner Brothers deal. The stock's up more than 10%. The bidding war just kept going, and then the regulatory concerns, and they were behind, and they just said, we're out, and the market loves it.
Man, and they're going to get $2.5 billion for their troubles, so good for them. I don't know if they get the money or the investment banks get the money or the lawyers get the money, probably a combination of all three. But I think that's a good move. I've really been smarting on this Netflix management team for the last few months, and I'm pleased that they're making the right decision. I think this is the right decision that they should have made a while ago, but at least you're going to force your competitor to pay an exorbitant sum of money for a company that's losing money. I don't know. I think Warner Brothers is decaying, I would say.
Yeah.
I mean, they generate about, $10 billion in adjusted EBITDA. They have $35 billion in debt.
No thanks.
And they're going to be bought out for $70 billion. It's expensive.
Yeah. Jack Dorsey, notably founder, former CEO of Twitter, he's been all over the place in terms of his career for the last decade or so. But his company Block laying off 40% of the workspace.
Yeah, formerly Square. They hired aggressively during COVID, and now they're firing.
They're
aggressively.
unhiring.
I mean, 40% of the workforce. That's like if you say, it's not even a look to your left, look to your right, one of you won't be here.
Yeah,
it's like look to your right, one of you is not going to be
Yeah.
here,
I mean,
which is wild.
It's pretty robust, and I'm curious. He did have a letter out on this. Curious your thoughts on the themes. Anything surprise you?
First of all, I'm going to get my pet peeve out of the way, and then, which you probably can tell already if you reading the notes. It was a direct copy and paste. And then I'll give you my larger thoughts. My pet peeve is that you're firing 4,000 people who have been coming in, or
Probably not. Let's be honest.
90% of these people are actually
They've
working
never
from
seen
home.
your office or any other employees.
But they've allegedly been working for the last number of years, and you're firing them, and you don't use one single uppercase letter. I mean, it's just like you wrote it in the Notes app, just casually. And actually, he posted it on Twitter too.
Even the Notes app would auto capitalize.
Yeah, it's harder to do everything in lowercase.
It's much harder.
And I don't get why.
I wish he would have done, who was it, Cam Newton, that had like his weird font that he tried to make a thing that was like wingdings. I wish he would have done it with that.
I mean, so he says, that means we're cutting by nearly half from over 10,000 people to just under 6,000. That means over 4,000 of you are being asked to leave or entering into consultation. So, I'll be straight about what's happening. Why? He says, we're not making this decision because we're in trouble. In fact, the stock was up 23%. But we're seeing the intelligence tools that we're creating and using are enabling new ways of working that fundamentally changes what it means to build and run a company. I could have either cut gradually over months or years, or be honest about where we are. Or I could
rip the Band-Aid. I like that. I think that's real servant leadership. Hey guys, I could have kept some of you around potentially for years, but I'm going to do credit to me for doing the hard thing and getting rid of you all today. And
I do wonder if this sets the stage for more layoffs.
I mean, you wonder. I mean, we talked about this, I guess, probably in 2022, where there was another number of tech companies that really were the first movers, but it really created a bit of a wave. It does seem like this would be something that would impact Salesforce and the like.
I mean, I look at Salesforce with 76,000 employees. First of all, you have software salespeople who are now going to have a much more difficult job selling their product to people who can create it in 3 hours. And then you also have all the engineers. Facebook was talking about engineers tripling productivity. Well, if you triple productivity, either you have a lot more work for them to do and a lot more things that you can accomplish, or if you're not a creative management team and you can't create more work, more productive work for people,
you dump the people.
Then you dump the people. And that's what Block's doing. And I do wonder if we're going to start seeing that elsewhere. And it's the Citrini report that we talked about is kind of comes full circle with what we were talking about Monday and Tuesday. And I think that this is the opening salvo. We have yesterday entered into a subscription with Perplexity Max, which runs Perplexity Computer, which launched yesterday. It costs $200 a month. And I kid you not, we have spent a lot of time and money building out things internally from a technology perspective. It did what took us, 4 to 6 months in 3 hours, which is just remarkable. I mean, you're talking about cost savings of 70, 80, 90, 95% in some cases, which is going to create a lot of efficiency.
And so we fired the guy that was doing that.
So it's I think this is real, and I think it's coming to a theater near you.
Dell stock, company we don't necessarily talk about a ton, but up 11% as well. Just blowing out the doors on their actual performance. And importantly, noting that gross margin was pretty good.
Yeah.
Continuing to see this theme of good operators.
Yep. Yeah, we knew orders and revenue were going to be strong, but the hit on Dell was that they were basically shipping these servers and losing money in the process, but their margins are actually performing better. And I think this theme of, as we shift from training these large language models like ChatGPT or Anthropic to inference, which again is when you ask ChatGPT a question, how it thinks about and spits out and sends that result. We're seeing the shift, and that requires a lot of compute. And I think the thinking initially was that it requires less compute. Well, it requires a lot more compute, which is why a lot of these companies are ramping up. And importantly, this Perplexity Max, for example, it has a tiered system where you pay a certain price of $200 a month up to a certain number of tokens that you generate. I think it's 10,000 tokens. More tokens than that, it costs more money. So we're starting to see these revenue models evolve, but it's not the software companies, it's the AI companies. But we also know the AI companies are spending an exorbitant amount of money. NVIDIA's having to subsidize them to the tune of $70 billion. It's a real high leverage situation. Lots of money moving around, and we just don't know exactly what the end financial models are going to be.
Maybe the most important economic news of the day: Trump's starting a college sports council.
Yeah, I wanted to hear your thoughts on this.
It's very interesting to me. I mean, you're going to have Ron DeSantis on it, known college sports guy, Ron DeSantis, the president of the New York Yankees. It's interesting to me how little emphasis there's actually being placed on people with direct experience in college sports. Now, you do have Nick Saban and the likes being there. I mean, Trump was golfing with him and with Urban Meyer, I think, a couple weeks ago. And Trump was on a podcast last week, and he said they mostly talked about politics, not sports, but, it is what it is. But I don't think anything substantive is going to come of this. At the end of the day, the regulatory body of college sports is the NCAA, and for years and years and years and decades, they over-controlled things. And whether it was policy, whether it was suspensions, whether it was oversight, you name it. And we've swung so far the other way, and I think the genie is out of the bottle, and I don't know that the NCAA or any other governing body or sports council is going to be able to fix the things that people are very apt to complain about right now.
I think it's setting up for another Supreme Court ruling. I mean, we went to the Supreme Court, a few years ago, and they were like, you guys go one step further, and you're going to have big antitrust issues. And I think that they're trying to get an exemption. I don't know how you can get an exemption from antitrust.
Yeah.
I mean, I guess utilities can get an exemption, but I don't know. I think that's going to be really, really difficult.
I'm curious to see if anything does come of this. At the end of the day, this seems like an issue that we talk about it all the time. Like, what does Trump really care about? It's something he talks about all the time. College football is not one of them. I think he likes it. I think he likes the spectacle of it. I think he likes the show. I mean, he's been to a number of games. He last week was saying how much he loves Gunnar Stockton. Now he's got to come to one of his games. I think that's fine. From a policy standpoint, is this a priority? I think it's going to be a couple meetings, probably a press conference out on the White House lawn with a bunch of former coaches, and that's going to be it.
I'm waiting for the council on fixing the NFL kickoff rule.
I mean, he talks about that all the time. I mean, he was on a college football podcast, and he opened with how much he hates the NFL kickoff, and talked about it like it was brand new this year. It's like this has been there. In the grand scheme of the history of the NFL, that is a new rule, but it's not actually a new rule anymore. But he hates it. Next week we'll get ISM manufacturing on Monday. Something to kind of keep an eye on there. I think we're looking for hopefully some signs of positivity there that would be in line with some of the data we've talked about this week. We will have some earnings still kind of trickling through. Target, one of them, Broadcom. What's top of mind, though, for you?
ISM manufacturing, I mean, I know that even if if you're in business right now, you are really optimistic because of the ISM manufacturing, or you're cautiously optimistic because of last month's ISM manufacturing. You want to see more of that.
Yep.
It's going to be reflexive, which means you're going to have companies that look at that report and say, "Oh, people in my industry are starting to get a little bit more positive. I can be a little bit more positive."
Yep.
And so it is, it is an important data point from that standpoint as well. Target and Best Buy, I don't think you really have much informational value there. Broadcom on Wednesday, what we've seen is a consistent pattern of AI companies, with Dell notwithstanding, but like NVIDIA and others have great performance and not good stock returns following that. And so I'm curious if Broadcom can buck that trend, but it's heavy. Like the whole space is heavy, which means that there are people who are just willing to sell any rally. And there's a lot of longs in there who are kind of sick of taking the pain and who are going to dump. And so it's tough. Like we've got to have something that flips things somehow. And so maybe Broadcom can do that, but it's a lot of heavy lifting. The other thing on Wednesday afternoon, you have the Fed Beige Book. Usually this is just kind of a litmus test of what the Fed's seeing. Right now it's very important because I'm curious if the Fed is seeing what we're seeing in terms of inflation and in terms of employment.
Yep.
And so the Beige Book will tell us that. Are they grounded in reality, or are they kind of listening to some other voices in the room? And then Friday, of course, we have the BLS employment report for the month of February. Is that January number going to be real, or are we going to see negative revisions yet again? And what happens in February? So some really key pieces coming next week that could set the stage for the month of March.
Yeah, I think the data is still what's most difficult. I feel like the gap between what it seems like is happening and what is being reported is very wide.
Yep.
So something to keep an eye on. The reality is the block layoffs is not shocking. It's something we've been talking about all year. We've expected relatively strong economic performance and employment to weaken. And from a data standpoint, so far this year, we've gotten the opposite, where, growth is not as high as maybe people thought it was going to be, and employment is stronger than we would have thought. And I'm not quite buying that narrative yet.
Yeah, I mean, even in the GDP, that weak GDP report, if you back out the government shutdown and like that weird price index, I mean, then you're kind of in the mid threes. And then again on the January jobs report, I'm really curious to your point, Andrew, does that hold up or not?
Yep. All right, we'll wrap it up there. Y'all have a great weekend. Talk to you Monday.